All right, I'm watching the participant count go up, and I think I'll get going. All right, it is a great privilege and honor for CFA Society of San Francisco to welcome Edward Chancellor, the eminent financial historian. Mr. Chancellor was educated at Cambridge and Oxford and worked for Lazard Brothers and GMO in addition to his work as a writer. And Fortune magazine has called him one of the greatest financial historians alive, and with good reason. We all know it's difficult to predict turns in markets, especially if your predictions come in the form of books. But Mr. Chancellor wrote The Devil Take the Hindmost, a history of financial speculation, which was well timed for the peak of the speculation in tech stocks in 1999. He wrote Crunch Time for Credit, a story about the excesses in credit markets, came out in 2005, a prescient warning of what then became the global financial crisis. And now Mr. Chancellor has written topic of today's conversation, The Price of Time, a masterful survey of the history of interest rates. And that warns of, well, we'll find out. We'll find out today. So, so Edward, if we could easily find on the internet 50 thought pieces that say interest rates are just too high, and another 50 thought pieces that say interest rates are just too low. And based on your book, I expect we could pick any day in the last 5,000 years, and that debate would be going on in some fashion. And so I want to start by just asking you, in the history of finance and of interest rates, sort of what have been the main camps or theories about what level of interest rates are right?
Well, it's good question, Ken. I mean, first of all, I would say that, for most of the history of lending at interest, which goes back, as you say, 5 millennia, the most vocal uh, proponents have always been for lower interest rates, and that if you go back into the sort of ancient world, you can find it in the Bible, the where and you find it in really you find in the Bible the fact that usury or lending at interest was considered illegitimate. You find it in um, Greek philosophy, like Aristotle and Plato, both decrying lending at interest. It's taken on in the early Christian church and then becomes established in the Middle Ages. The idea that lending at interest was illegitimate, that usurers or bankers in Dante's Inferno or in, I don't know, the third or fourth circle of hell. And then when lending becomes progressively legalized from the 16th century onwards, there is still a debate, as you know, I mentioned in the book, with people demanding lower interest rates. In that case, they were actually demanding in Britain in the 17th century that the maximum legal rate of lending be reduced. However, there's actually something quite interesting that comes in here, is that the by the 17th century, the advocates of lower interest charges are actually business people in the City of London. I mentioned this fellow Josiah Childs, who was rich banker, who was head of the East India Company, who was really speculating in East India Company shares and borrowed money. So naturally, he wanted low interest rates. Then, if you sort of fast forward into the 19th century, you get the socialists, and I cite, you remember the beginning of the book, sort of socialist anarchist Frenchman Proudhon arguing, debating for zero interest lent by a central bank, quite similar to what the central banks were actually doing in the last decade. And that really continues until we get into let's say, into the 1920s, where John Maynard Keynes pops up as an influential economist, and Keynes, as I say, never saw an interest rate that he considered too low. He was always calling for lower interest
Mhm.
rates, and actually, I think that sort of Keynesian view of interest being something rather sort of that one should keep as low as possible has prevailed into the into policy making circles in the post-war period. And then, as I also mentioned, in emerging markets, interests are often very unpopular. If you remember the Turkish president Erdogan is always
Yeah,
decrying what he calls
right.
the interest rate lobby. He calls them
Mhm.
as a sort of sinister cabal of people around the world trying to push up higher interest rates. Whereas I say, if an interest rate lobby actually existed, Erdogan himself was the main mouthpiece, and they were always calling for lower rates, and that's really has been the case. And to some extent, my book is an argument against that, not an advocacy of high rates in themselves, but as we'll discuss, it's it's an argument to say, well, actually, the interest rate serves a
Right.
number of vital functions of communicating to economic agents how they should behave. And if too high, yeah, pretty obvious. It's
Mhm.
a bad thing because
Yeah.
you crush the debtors. And again, if you go right back to the ancient world, it was quite grounded, the idea that very high interest rates were an abomination, because if you're in a primarily agricultural economy with no growth, if you have a high interest rate compounding over time is simply unbearable. And in the ancient world, as in certain parts of the modern world today, high rates, the compounding of debt at high rates of interest could send people into debt bondage or even slavery in the ancient world. So that's, obviously a pretty bad thing. On the other hand,
Right.
once you get into the modern world of sort of capitalist world, which we might say starts sort of sometime in the 15th century in Europe, then yeah, of course, people are borrowing money for commercial purposes. They can earn a decent, if they're competent, they can earn a decent return on their borrowing, and it's therefore legitimate, to my view, that the lender should share in the gains of the borrower, have some share of that, and so I think that as you say, that there are people always arguing that interest rates too high, too low, and it's a very, very difficult problem to solve. It's perhaps almost an insoluble problem to discover the correct rate of interest, which is an issue. However, as I say in my book, you can probably tell when they're too high, and you can probably tell when they're too low. You may
Yep.
not be able to hit your the right rate to sort of 2 decimal points, but you can probably get it within a percentage point or
Mhm.
two.
So speaking of that, as you say, the camp advocating for lower interest rates tend to has had more sway in the outcome than the camp advocating for higher interest rates. And one thing that the book demonstrates is that the winning camp, when they succeed in having rates be low, sometimes that leads to unintended consequences. And I wonder if you could share with us some of the instances in your grand survey of interest rates where there was a stretch of very low interest rates and it turned out badly.
Well, so first of all, I'd say I mean, as you know, I make the point in the book that interest rate is, influences the valuation of assets, the capitalization rate, or the discount rate used to value assets. And what I argue in the book is that the great speculative bubbles, really all the great speculative bubbles in history, have occurred at periods when interest rates were abnormally low, during periods of what we call easy money. And that I hadn't, you mentioned my earlier book, Devil Take the Hindmost, which have a whole chapter on the tulip mania of in Holland of the 1630s. But in that book, I hadn't actually realized that interest rates in Holland in the in the 1630s had declined pretty rapidly from the earlier period. That the central bank of Holland was issuing more notes, and there were large capital inflows into Holland at the time. So there was clearly a monetary aspect to even the tulip mania. But if you go, I mean, the case I give most space to in the early parts of the book is John Law of the Mississippi Company fame.
Yeah.
And again, I hadn't realized before writing the book that John Law, so I mean, for your members who are not really familiar with John Law, he's a Scotsman, a brilliant mathematician, an economic theorist, a gambler, who travels around Europe in the early 18th century, and he comes to France in the around 1710, and he's full of ideas. And one of his ideas, he wants to modernize French finances, and he wants to relieve the government debt, which at the time was very high, owing to the fact that Louis XIV, the so-called Sun King, was always engaged in costly foreign wars. Louis XIV dies in 16 in 1715, and and Law has his opening. He manages to persuade the new ruler of France, who's the regent, to start a bank, and that becomes the first central bank in France. And he also has his starts his Mississippi Company, as we call it, which merges a whole load of French corporations together. And what Law does is he replaces gold and silver money in France with a paper money, and he also offers via the Mississippi Company to take over all the French government debt, and this is funded really through paper loans made by the Royal Bank. Now, the key point about this, about Law's experiment, is that he was, as his academic biographer Antoine Murphy says, he was a low interest advocate, just like the modern central bankers were up until recently. And he engineered a decline in French interest rates from about sort of range of 6 to 8% down to about 2% in 1720. And at that time, he also lent a lot of money from the central bank to pump up the Mississippi Company's stock. And the Mississippi Company's stock then went to a price earnings multiple of 50 times. And as it paid out all its profits, and perhaps a tiny bit more, its dividend yield was 2%. So you can see that the dividend yield was brought down in line with the interest rate. And Law at the time said, don't worry about the price of Mississippi stock. It's justified by the low rate of interest. Then, inflation
Heard that
seeps
one
into
before.
the system.
Right.
Yeah, you've heard it before. Yeah, it's what we call the Fed model now.
Yep.
It's the earnings yield of the
Yep.
market above
Mhm.
the treasury yield.
Mhm.
And then inflation seeps into the system. Law has to sort of engage a bit of monetary tightening, and the system collapses, and Law has to flee the country at the end of 1720. And this actually is, a disaster for France, because they scrap all Law's innovations, throwing out the good ones, some sort of modern finance with the bad ones. And that really means that France, I don't write about this in the book, but in France through the rest of the 18th century remained with a very backward financial arrangements and government debt arrangements, no central bank, no bond market, and so on. And then, the French, insisted on funding the Americans in their revolution, and became crippled with their debt, and that
Uh-huh.
really engendered the French Revolution. So you can see that a financial mishap can have a very long tail. And then
Mhm.
later in the book, I mean, I argue again, I argue that the ebbs and flows of financial crises, through the 19th century tend to coincide with periods of low interest rates, and that in the 1920s, although nominal and real rates of interest appeared relatively high, they were actually low regard in relation to the extraordinary economic growth of the
Mhm.
1920s. I think economic, I'm saying that I think sort of productivity growth was running in the range of sort of 7 to 8% a year in the 20s, and rates were kept below nominal GDP growth. And I think, although I say one doesn't really know what the fair rate of interest is, if an interest rate is kept below the growth rate, the nominal GDP growth rate, that's often a sign that the rate is too low. And then what did we have in the 1920s? We had, obviously, the stock market, the great uh, stock market bubble funded initially with margin loans. You had real estate speculation across the country,
Yeah.
from
So
Chicago.
that's one of the mechanisms whereby I mean, your book has a number of instances where interest rates were kept at a low level for a period of years, and then there's a crisis. And the Mississippi bubble is one of many in the book where that happened. And I think it would help the audience to just elaborate on sort of what's the mechanism whereby like very low interest rates, as you say, perhaps interest rates lower than the nominal growth of GDP, sort of lead to the conditions that become a crisis.
Yeah, well, so I I say that, interest serves a number of functions.
Mhm.
Um, we've discussed capitalization rate. In other words, the
Uh-huh.
relationship between the interest rate and the valuation of assets, how easy money can lead to speculative bubbles. Interest is also affects risk appetite. I have a chapter, where I cite an 18th century Italian intellectual called Ferdinando Galliani, in which he says that interest is, I love it. He calls interest the interest is the price of anxiety. And that all lending involves some anxiety, or at least it ought to, and that the lender should be compensated for anxiety. And I say, well, actually, look, let's put this in modern language. Interest is the price of risk. And it's also, if you want to, be a bit more boring about it, it's the obviously the cost and price of leverage. And that works two ways. You lower the interest rate, and we all know this from our professional lives. If you lower interest rates down to very low levels, you create an incentive to chase yield. And if you once investors get engaged in yield chasing, they they tend to lower their lending standards. And we saw that, very clearly in the run up to the global financial crisis. And it's tend to be people have tended to forget that, that the origins, at least to my mind, the global financial crisis lie with, the easy money that followed from the dot-com bust when the Fed took rates down, its policy rate down to 1%. Anyhow, so if you think back to the global financial crisis prior to it, the reason all that, that subprime lending was popular and
Mhm.
the reason, CDOs became fashionable is that you could get a yield pickup on an investment grade tranche in a CDO. In other words, you were packaging more, you were both combining a real estate bubble fed by the low rates with a lending boom that was funded by banks and investors who were seeking an incremental yield pickup. And then, on the other side, you've got the borrowers and who when interest rates will low will lever up, and so that is problematic. And there's another function, if you remember, I have another chapter in my book on capital flows. And this is important because when interest rates are low in the core of the financial system, and that would be in Holland, in the 17th century, in Britain from the 18th and 19th century, and then, United States thereafter. When rates are low at the core of the financial system, there's a huge incentive for this yield chasing to take place across borders. And so you get these foreign lending booms. And the first one I chart is, or mention again, which is also mentioned in Devil Take the Hindmost, but it is the Latin American lending boom of the early 1820s. And what you see, and there, the newly independent Latin American republics all borrowed, and they were at a time when interest rates were low in Britain, and investors in the City of London were looking for higher yields, and there's a great surge of foreign lending, and every single one of those debts defaulted, including a debt, a loan raised by this Scottish buccaneer, sort of con man called Gregor MacGregor, who styled himself the Cazique of Poyet, which was a little territory on the Darien Peninsula. And Gregor MacGregor, the Cazique, claimed it had great prospects. They raised, I think, £500,000 loan. All these loans initially had a sinking fund, and they paid their coupons out of the sinking fund. So they tended to pay one or two coupons and then go bust. And then we see that through the 19th century, the great Argentine boom of the 1880s that collapses in the early 1990s and brings down the great merchant bank, Barings Brothers. At least for the first time, it got up off its feet and then got knocked down again a century later. But that was also induced by low interest rates in Britain, and then the 1920s again. The relatively low rates in the United States compared to the yields available in Central Europe and in Latin America encouraged massive capital outflows into those countries. And then it was really the reversal of capital flows from the U.S. Basically, the Americans started tightening money in early 1928. Capital ceased to flow to Central Europe and Latin America. In fact, actually, the Europeans started lending their money into the US because you've got very high rates on these margin loans that are very popular.
Mm-hmm.
It's very important because Americans tend to oversee this, is that the beginning of the Great Depression really comes from weakness in Europe and is triggered initially by the collapse of the Austrian and German banking system. So that's a nice example of low interest leading to capital flows, the reversal of capital flows leading to, after all, the greatest financial.
Yeah, your book talks about that, about how when rates are really low, then investors become more risk-seeking because they get right such a paltry amount from fixed income, then they end up doing, as you say, investing overseas or investing in more speculative ventures. But you also in your book talk about how low interest rates can lead to sustained misallocation of capital. as well. I wonder if you could elaborate on that.
Yeah, I can. I mean, this is very important to my mind. Uh, the the one of the functions of interest is to determine, as you know, whether an investment, a capital investment, is viable or not. So the interest rate is linked to the hurdle rate on an investment, or to the payback. These just back of the envelope calculations on whether an investment is viable. If you lower the rate of interest, you will make certain investments viable that wouldn't be viable at a higher rate. And to my mind, that works two ways. First of all, it keeps businesses that have too low a return on capital um, in business that would otherwise be out of business. So a very low interest rate becomes a type of loan forbearance. And what I argue is that we saw this in Japan in the 1990s with the combination of the beginning of the zero interest rate policy with the banks actually straightforwardly engaged in loan forbearance and of not pulling the plug on very weak, unprofitable, over indebted companies. And I argue that the ultra low rates of interest after the global financial crisis encouraged the formation around the world of these so-called corporate zombies, and a zombie being a company that, even despite low interest rates, is unable to cover its interest costs from profits. And zombies are, I argue, poor for productivity because they're associated with low firm exit within an industry, but also low firm entry because the industry is sort of clogged with relatively low investment levels and low productivity growth. So you can see you don't really want to encourage the formation of too many zombies. So you could, I mean, I've mentioned Jim Grant, the financial writer. He talks about the interest rate being like the tempo at which an economy is run, so that as you lower the interest rate, you slow the tempo until finally, at zero rates, you get to a sort of death march.
And it isn't what you just said contrary to the notion that many people, including central bankers, have that, well, if the economy is sluggish, then lowering interest rates is just the thing to get it moving faster. It sounds like
Yeah.
what you just said is, well, wait a minute, you're actually like going to a lower tempo.
Yeah, I think so. And I mean, obviously, I have two advantages over central bank, and one, I have the benefit of hindsight, and
Yeah.
the other is that as I didn't implement these policies, I'm not therefore responsible for covering up any policy error. No, I think the central bankers thought, oh, we lower rates, companies will borrow more and they'll invest more, and then economic growth will take off. It didn't happen that way, and in part, as you know, Ken, and I
Mhm.
write about it, but we all saw it, is that when interest rates were extremely low, companies tended to turn to financial engineering
Yep. Cherry purchase. Yep.
by using the debt to pay back to buy back their shares and lever up, which gives an immediate return to stockholders. It tends to be applauded by your activist investors, and is popular with senior management who are paid with equity-based incentives. Whereas and it has very quick payoff too.
Mhm. Yeah.
Whereas if you invest in a new plant, it's going to take longer, and it's in a way higher risk for a sort of a manager with short-term horizon. Anyhow, I want to just continue. I want to just say that the capital allocation story is not just about zombie companies. And although zombie companies, as I say, you know, slow creative destruction. And that slow creative destruction, the slowing of creative destruction, which the Austrian economist Joseph Schumpeter calls the most vital force in capitalism, is in itself a bad thing. But the other aspect of very low interest rates is that they encourage investment in long-dated assets. And I would say, as none of you so far from Silicon Valley, that Silicon Valley was one of the prime beneficiaries of the ultra low rates for two reasons, really. One is, sort of returns chasing.
Mhm.
Again, with low rates threatening to depress returns on portfolios, there was an incentive to go in, more onto the VC side of things, but also because venture capital investments by their nature uh, produce profits in the long distant future. Not all of them, but in general, and that therefore those long dated profits have a higher value, current value, at times of depressed interest rates. And I think what we saw then was a sort of slew of investments, a great Silicon Valley boom that became, I think sort of, to my mind, rather sort of, it became rather irresponsible uh, in its last years, and funded a lot of businesses that probably shouldn't have been funded. So you've got sort of capital trapped in low return businesses, and then capital diverted to sort of high, potentially high return but very distant return ventures that then get that then the plug is pulled, and we see that. I mean, I think really, you see that with a whole load of the funding of electric vehicle businesses. You look at the Wall Street Journal on almost a weekly basis. You see another EV company going to the wall. You see, actually a lot of the alternative energy, very long dated. These wind farms and so on, where all the capital costs are up front, but returns in a more distant future. So if you have a low rate of interest, these businesses become viable, and suddenly you change the rate of interest, and that business loses its viability. And you have a lot of, and we haven't mentioned it yet, but we can do with, obviously a lot of money going into commercial real estate, because the real estate developers love love easy money more than anyone else on earth, and you sure that
Maybe not as.
the marginal developer
Mhm.
will borrow and lever up to the highest possible rate and overbuild at when rates are very low, and which is seems to me the situation we
All right.
got ourselves into.
All right. Yeah, I'm starting to get some questions. By the way, all of you in the audience, just type your questions in the Q&A, and I'll try to get to them. First, though, I want to ask about the recent period of low interest rates. Reading the book, which contains, as we discussed, multiple instances where interest rates were suppressed for a long period, and then there was a crisis, got me thinking, well, we just now recently had the lowest interest rates ever, a large portion of the sovereign bond market having negative yields, in fact. And given the pattern that your book establishes, it suggests that we could be in store for some trouble in financial markets. It doesn't seem, other than the bond market, it doesn't seem that that trouble has manifested itself yet. But I'm very
Yeah,
interested in having you comment on, like, one of the reviewers of your book said, "Well, now that I've read, Mr. Chancellor's book, I'm just going to sell everything because we know what happens when interest rates are really low for a long time."
uh,
So what do
um,
you think will happen this time?
I wouldn't actually necessarily advise that, but everyone can do what they want to. The so So this is interesting.
Hmm.
Um, I mean, I have to say, there is an element of sort of there's a doom-laden element to my book as you get towards the end.
Yep.
And I think when when I was sending it to the publishers, they had some sort of blurb, which they'd written saying, oh, well, unless policymakers come to understand this, will the world move towards another financial crisis? And I say, no, forget it. This is we're far too late to get out of this hole that we've dug ourselves in.
Hmm.
And so then what? And it is, you know, it is interesting what's happened over the last couple of years. Because I sent the book to the publisher but really before the Fed and any other central banks had tightened. So in 2022, the Fed starts to tighten. And as you mentioned, we get this, huge sell-off in the bond markets. And the bond market crash is really phenomenal, actually. Apparently, the bond declines in 2022 were greater than in any single year since the creation of the first sort of long bond issued in Britain in the 1750s, so-called consols. And you have some of these bonds, like the Austrian 100-year bond selling off 75%. And
Yep.
you have a UK linker index linked bond, 50-year bond going off, also down 75, 80%. So you get a pretty big bond crash. You get a sort of decent bear market, if you remember,
Hmm.
it, but it doesn't last very long, and the markets come back pretty quickly. You get this expectation of a so-called hard landing and a recession, and that hard landing and recession doesn't immediately arrive. And then you get this flurry of interest around artificial intelligence and a new sort of speculative boom in the market, initially concentrated around the so-called Magnificent Seven stocks, all of whom have some sort of AI story to tell. And so that's sort of where we are. There are reasons. So why have we not had a hard landing? Um, I think, in part, simply, the US federal government borrowed and spent a huge amount of money last year. So they sort of preempted any hard landing before anything had come about. I think the AI, I mean, I would call it a bubble, but the AI boom has rekindled animal spirits, as you see, meme stocks are back in favor. Game stop or whatever has risen from the dead. And my view is it takes I thought about this a bit more, and some it takes a while to readjust to the higher rates. Think corporations uh, took advantage of the very low rates to lock in the very low rates. And people got uh, interest rate swaps when they borrowed, even when they borrowed at floating rate, again to lock in for 2 or 3 years into low rates at very low cost. I think real estate developer could insure uh, that they get an interest rate swap on $100 million loan for $57,000 back in 2021. So you'd have to be a sort of pretty dumb not to spend that 57,000 to lock in the rates. And then a lot of in the US, a lot of the most homeowners termed out their borrowing with fixed rate borrowing, and so what I think that means is that it's taking a while for the markets to really sort of take on board the readjustment to higher rates. And I mentioned commercial real estate. I think because a lot of commercial real estate funding is floating rate, that is actually pretty much a slow motion train wreck, and you can read perfectly respectable analyses of the commercial real estate situation that that makes it sound fairly horrendous. You've got, on a global basis, you've got China's real estate bust is going on. And to me, as you know, I've got a chapter on China in the book when I talk about the buildup of debt and the real estate bubble and the overinvestment. I think the China story again is, quite slow play, but really a very big story. And then, and look at Japan, Japan took, after the bubble economy, another boom that was, created in some part by easy money from the Bank of Japan in the 1980s. It took, a couple of decades to play out. So my sense is that there's a pig in the python. The pig
Okay.
slowly moving through it. We're talking about, the economies and financial markets, they're very complex systems, aren't they? And therefore one never quite knows when things are going to be triggered.
We have a question that kind of relates to this thread of the conversation. Of course, we're here in Silicon Valley. Many of us have, worked at tech firms or have positions with tech companies. And as you said earlier, the very low interest rates sort of induces more investment in long duration assets, including, startup companies whose profits are well down the road. The questioner is asking, right, that made sense, or that could be why many things were funded in, 2020, 2021. But now that interest rates have risen quite a lot, since then, we're still seeing, a recovery to record highs for, NASDAQ 100 and other kind of tech indices. So then does
Yeah.
that mean that can long duration assets get priced up, low interest rates are high?
Um, well, I mean, it's it's pretty anomalous, I have to say. The uh, the rebound of Nasdaq
Mhm.
and the insertion or the appearance of this, AI frenzy,
Mhm.
just as all these SPACs, the
Yeah. Oh yeah.
SPACs that merged with the
Uh,
like flakiest tech companies, you'd ever heard of. That just as those SPACs were, down, 95% and going bust, you suddenly had this sort of bunny boiler of a sort of new tech boom rising from the dead.
uh-huh.
And that I mean, I have racked my head to ever seen anything like it. And what we've seen historically is good old-fashioned bear market rallies.
Hmm.
And sometimes the bear market rally, takes the market back, quite close to its highs. This is, if this is a bear market rally, it is.
Even though new record highs are being set,
Yeah, yeah. If
you
it
still
were a
see it
bear,
as part of a longer bear market.
and then I mean,
Huh.
if it were, I'd say it was the greatest bear market rally in history.
Uh-huh.
And I don't know, you can take, you said that someone read the book, a reviewer read the book and said, sell all your stock. It's not the message of the book. Because actually, I think one of the problems
Hmm.
that I identified
Yeah.
uh, from the low interest rate era, and bear in mind, as you mentioned, I was working in the asset allocation team at GMO for the
Mhm.
first half of the decade. And we were finding relatively few investment opportunities. So and whereas in the previous period, at least at the end of the dot-com bubble, there was huge investment opportunities, in stuff outside of Nasdaq. The
Mhm.
Nasdaq might have been, fated to go down 75%. But you could if you had your head screwed on the right way, you could invest quite cleverly. I think at the end of, going into 2022, it was very difficult to think of of which assets were particularly attractively priced. And therefore, I think under those circumstances, you need a tiny bit of diversification. You don't want to.
Mhm.
I think the good news from an investment perspective over the last couple of years is that while the stock market remains uh, pretty expensive in the US, the bonds have repriced, and in particular the inflation protected bonds, the TIPS, now yield a really decent return to my mind, sort of, in
Yep,
range.
a lot better than it was.
Yeah, so and even if you
Yeah,
go to Japan, the
yeah,
30-year bond is no longer yielding negative, but you get, I don't know,
yeah.
200 basis points on it. So
Mhm.
from an asset allocation perspective now, I mean, my view is, I wouldn't put all your money on there not being a next leg down in the bull market.
Mhm.
Um, but I think you can allocate capital. It's a somewhat better situation than at least than it was 2 years ago.
Mhm. In the book, it's going to riff on one of the questions. The question is asking, um, in the Mississippi bubble example, the questioner is asking, were market interest rates market determined then, and now they're kind of engineered by central banks. Uh, is that in the book?
No, I
In the
mean,
book, you kind of it's a pretty strong critique of how central banks think, and in particular, if if the guiding light is managing inflation up and down, you seem to be suggesting that they're missing some other guiding lights that might even be more important than that. So
yeah,
can you talk about the management of interest rates, what central banks have been
yeah,
doing in the last decade, and what you would have them do that's different?
yes. I mean, first of all, I'd like to clarify that the
Yep.
under the Mississippi Company, in John Law's period of preeminence in
Yeah.
France, it was a paper currency. So law, in effect, was manipulating the interest rates.
Mhm.
Under under the sort of gold standard system, um, which was sort of became predominant in the late 19th century, but you could say that sort of British was sort of engaged in that, from the early 18th century onwards. Basically, a central bank had to redeem its notes in gold at a certain with a certain fixed quantity of gold, and therefore what the central bank would do is when its stock of gold was high, it would issue more notes, and when its stock of low was and interest and lower interest rates, and when its stock of gold was very low, it would raise interest rates, and so the flow. You didn't need a PhD in
Mhm.
economics to find out what your stock of bullion was. So in fact, actually, what I quite liked about the Bank of England in the 18th century is it was sort of run by merchants. There was no economists within 100 miles of it. There were no bankers. Bankers weren't allowed near the court of the Bank of England because they were considered to be sort of likely to be undermining its purpose. Anyhow, so there, the under that system, I don't want to get into defense of the system because it does lead to very severe busts. However, the interest rate is being set automatically by the relationship between, if you will, the amount of credit outstanding and the underlying monetary stock, and the underlying monetary stock cannot be sort of fiddled with.
Yeah.
If you go into the modern world, because you've got a fiat currency system, which is basically depends on at the apex of which is the central bank, and they under which money can be created by the central bank to determine the rate of interest. You can no longer have a sort of a merchant who left school at the age of 12, determining what the interest rate is. Instead, you have to employ, hundreds of economists with their models to determine what the right rate of interest is. And I suppose I come at it, from the perspective that how could a committee of people know what the correct rate of interest should be? They set themselves too grand a task, and then they, I think, what's happened is everyone's sort of clutched onto, because the task was so difficult. They say we need to know, something to set the rate. So we'll just clutch onto this, inflation target. That'll be our life vest, tossed around in the uncertainties of the monetary world. And as you know, I say that the interest rate is not the current near-term inflation rate is not a good guide for setting monetary policy. The central bankers, to my mind, obsess far too much about deflation. I mean, think about Silicon Valley and computers and this and that. Huge every year falling prices. Yeah, falling prices are just a result, inevitable consequence of technological development, of productivity growth, and a welcome. People like falling prices, believe it or not, and yet the central bankers did their best to prevent to stop the price level from falling, which means, frankly, if you've got, let's just say you had, two products, uh, yeah, let's say you've got two products in a good and a service economy. One is your tech goods, your computers, and the other is, let's say, college education. And as the price of the tech product is coming down, you're going to have to push up. The central bank is going to have to push up the price of the college education in order to keep his average the same. It has a very corrupting effect, this near-term focus on inflation targeting, and I mean, I don't know the correct system to move to. I wouldn't advocate going back to gold standard. There is, a friend of mine who was former chief economist at Deutsche Bank, called Thomas Mayer. He thinks that you could create a central bank digital currency that grew only by a certain amount, was constitutionally created, that it would only grow by a certain amount a year, 2 or 3 percentage points. And that could, that would create a relatively fixed money supply, or at least with a constant rate of growth. And that, you could see, would allow for the interest rate then to be determined by genuine savings, and the demand for savings. So, I mean, really, I don't think enough thought has gone into, if central bankers cannot determine, if no individual can determine what the right rate of interest is, and we wouldn't ask them to determine I'm holding a pen in my hand. We wouldn't ask any individual to say, look, what are the components of this pen? How much should it be priced? We let the market determine the price of this pen. And
we just got a question. I know we're almost out of time, but it sounds like the questioner says, so data dependency is a pretty poor idea, but I don't think that's really what you're arguing. I think you're saying that just looking at one piece of data, which is the rate of inflation, and not looking at like what's happening to credit creation or to stock prices, right?
And leverage.
It's just right. It's a kind of myopic. What data matters, right?
Also, I mean, what I know about the central bank models is secondhand, but I think the central bank models also, there's a huge amount of theoretical input into it. They're very unrealistic. These are Their models don't actually include money in a financial system. There's one firm, like the representative firm. So that one firm doesn't, all this zombie stuff I told you about, doesn't really recognize that. You have, one individual, the representative investor. So the central banking is both a mixture of, a drowning in data, but also having, highly unrealistic models of what the world, of how the world actually works. But yeah, to go back to your point, I
Yeah.
do, you're going to be pragmatic and you're not going to have a new, monetary system. You can at least step back from this near-term inflation target and say, you know, is the deflate, say you were in a period of deflation, is this deflation debt deflation, which might be bad if it's going to crumble the financial
Mm-hmm.
system as it was in 2008, 9? Or is it the deflation that comes from higher productivity growth? Because that's a very simple question to analyze. And if it's the deflation from higher productivity growth, you say, well, this is the way to go. Yeah, you don't fight that deflation.
Yeah.
Likewise, with the leverage and I mean, I think, they, as you know, after the financial crisis, we introduced huge amount of, of financial regulation that, I'm sure it made your job a nightmare. It was a nightmare work. It became increasing nightmare if you're a working professional investor to deal with this regulation. But in the end, the regulation of the financial system cannot come properly just from printing new rules. It has to come from actually setting a rate of interest that prevents excessive leverage, that doesn't encourage the deterioration in underwriting standards and carry trades and the like.
All right. Well, with that,
Across judgment.
I think we could carry on and have this fascinating conversation, but I think we've come to the end of the hour. I thoroughly enjoyed this book. I highly recommend it. It's not just informative; it's also kind of engaging history of interest, and I learned a lot, and I expect that those of you in the audience would enjoy it as well. So thank you so much, Edward, for spending your time with the CFA Society of San Francisco.
Yeah,
Appreciate it's the evening in London and you joining us at your might be your dinner hour. So it's
my dinner is in the oven. Thanks a lot, Ken. I've
all
enjoyed
right.
it.
So we'll let you move to dinner then. Thank you. Thank you sincerely for joining us today.
Okay,
All
bye.
right.